Eric, have you been all right?
Yeah, good. Bouncing around the tri-state area now,
Oh,
but
you are?
not
Okay.
enjoying the cold weather. Yeah.
Okay. Good, good. Well, then you came back for the game of drones. I'm wondering, am I the first one that came up with that,
I
or if you?
think so. I haven't seen it.
Okay, well, I'm gonna copyright that one. Okay, I own the Bond Vigilantes now. Now maybe I own the game of drones. I don't think I own Magnificent Seven. I think I was early on to say it, but I think it just kind of caught on by itself. It's too obvious, so I'm not going to claim that one. But anyways, we've got some rain here, and it's a little bit on the chilly side. But all in all, things are good. What part of New York are you in?
Right now I'm in Manhattan,
Okay,
but then bouncing up to Westchester later
good,
on.
good, good. Okay, well, let's get started. Lots to talk about. This is Fed week, and just as we predicted last week that there would be an article in the Wall Street Journal suggesting that the Fed might pause. The only ambiguity in the article is it wasn't that obvious whether the pause would be on Wednesday or it would be the next one. I think there's anything in there that persuaded the markets from thinking that there'll be a quarter point cut on Wednesday. Is that the way you read it?
Yeah, probably a quarter point and then pause from there.
Yeah, and you pointed out to me that the article really focused on the dissenters, right?
Yeah, some of the Hawks have a little more credibility now, or more sway, and the Doves, um, you know, they have to kind of backtrack a little bit. But there was only one recorded dissent over the past few months, but clearly, and we've been writing about this. Clearly,
Yeah,
there was a lot more dissent under the hood.
yeah, yeah. And I think the article said that Powell came up with the word recalibration as a way to kind of convince the possible dissenters to stay with the story that he wanted to tell. And so I think they just kind of got a little panicky over a soft patch in the economy and did what they did. It's not exactly the end of the world. It's not a calamity, but then again, we have valuation multiples in just about everything near record highs. Certainly in the stock market, home prices are at an all-time record high. Gold is at a record high. Bitcoin is a record high. So there's a lot of indicators suggesting that interest rates aren't as restrictive as the people like Powell and others fear. And the more work that you and I do the um, on the neutral rate, the more I'm convinced it's totally useless. But then again, just because you and I might agree on that, we have to acknowledge that the Fed seems to be driven by that. So when the economic projections comes out on Wednesday, we'll all be looking at all the components. And what's your thinking? They going to change anything on that summary of economic projections?
Yeah, I mean, they'll probably raise their real growth and inflation expectations, or at least real growth, and then probably the long-term Fed funds rate or R star, whatever they want to call it.
Yeah.
I think we'll drift closer to the top end of that dispersion in the dot plot for the median. And I'm sure there's still a few doves who think the neutral rate's quite low, but I think more and
Well,
more the average voter will put it higher.
yeah, my hunch is they're not going to go from. I think they're going to go from 2.9 to 3. I don't think they want to do
Yeah.
anything radical. They just want to signal that they're acknowledging that it might be higher than 2.9. Of course, we're of the opinion that the data pretty clearly suggests that we're at full employment and inflation is getting pretty close to 2%. So we think that the neutral rate, even though we don't believe in it, but if you pin this down, we'd say we're probably at the neutral rate right now. I guess my problem with the neutral rate is it's determined. It doesn't. It's sort of interdependent. In other words, it doesn't. It's not an independent variable that drives the economy, it's also depends on the economy. So there's a lot of linkages between these things, and we know the economy changes. It's dynamic. Things change in response to certainly fiscal policy. Um, and so when it may just be a moving target, and who knows, if everybody agrees, and I think everybody does agree that you can't measure it and that it might not be stable, that it might change over time, then the question is how often does it change? And by the time you get, I think did I mention the Heisenberg uncertainty principle last time, Eric? I might have, I don't recall, but the principle in physics that says if you know how fast an electron's going, you don't know where it is, and if you know where it is, you don't know how fast it's going. And I think it's part of the insight of that is that the experiment itself, the attempt to see where you are, actually can change where you are. So the monetary policy has an impact on the real rate. And if they lower interest rates here, that in a way that's really not necessary, then they may just get more speculative juices flowing in the economy. Uh, Eric, I don't know if you noticed some data came out from China. Retail sales was weak. It was up 3%
Yeah.
on a year-over-year basis. What did you see on the 10-year bond yield over there?
Yeah, I mean it's 1.7 or just north of 1.7%,
Yeah,
which is
just
pretty
kind of taking a dive.
yeah, I think the Politburo kind of committed to 2025 just pretty easy monetary policy. It almost looks like they're doing like the post GFC playbook for America. They had a property bubble bust and they're trying monetary stimulus when, they'd be better off with more of our COVID playbook and helicopter money.
Yeah, but I mean, I don't know how controlled their bond market is. This drop in the bond yield kind of seems to me that it's their bond is basically telling the government that they have to be concerned about the economy getting weaker. They have to be concerned about deflation. So if I'm not sure that the bond market's influenced that much by what the central bank's doing, but bond market's basically telling the central bank to ease off.
Yeah.
Um, so that's just I'm again if I if I had to kind of come up with a policy to deal with China's problem, I think it would be pretty simple just to copy what the U.S. did with helicopter money and hope that if the government sends checks into people's checking deposits that they spend it. The problem is
Yeah.
they might not. They might save it much more so than Americans did when they got their checks. Um, we got the New York Fed. You saw the New York Fed regional data?
Yeah. Current conditions basically went from a near record high around 30 back down to zero pretty
Yeah.
quickly. Other than that, like the future outlook still looked pretty good. Dropped a little bit, was still around
Yeah.
24. And then like more good news would be that like prices paid and prices received dropped. So a less inflationary
Yeah.
print.
Yeah, I mean, it's a very volatile series, so we
Yeah.
try. We only point it out when it supports our story. What it doesn't, we point out it's a volatile series. But there's four more surveys to go, and we still think that on balance, they're going to be pointing out to a manufacturing PMI that's above 50, which it hasn't been for a couple of years, not sustainably, anyways. Uh,
Mhm.
Eric, what else do you want to talk about? I guess we're looking at 2025, and I think we've sketched that out pretty well. Anything you want to add? I mean, we're talking about growth being 3% and more because of productivity. We did a lot of work on productivity recently, and in today's morning briefing, as a matter of fact, that's how recent. So we'll look at that in a second. Um, but yeah, why don't we just get into the charts, and that'll probably keep us focused on where we're going from here in terms of our forecast. All right. Okay, here we go. So today's December 16th. Let's look at this first chart. So we had a whole bunch of indicators, particularly on the inflation side, come out last week. Everybody focused on the CPI, which was as expected. PPI was a little hotter than expected. And then I guess, Eric, when is it? Thursday, we're going to get PCED?
I think it's Friday.
Friday. What's
So maybe
what's your thinking? Is it going to be in line with expectations? Is it going to be hotter? What do we know from the CPI and PPI that tells us something about the PCED?
Yeah, so I mean, it's interesting that the Fed's meeting is just a couple days before the PCED, so they won't have it. But you can pretty much infer what it'll be from CPI and PPI. And we had pretty hot, core services PPI and like the consumer aspect of it. So everything points to the PCED at least remaining around 2.8% for the core rate at least
Yeah,
year over year. There's one kind of quirk or a couple quirks where the PCED will pull airfares and portfolio management fees from PPI. Those both actually went down in November. So a lot of forecasters took down their expectations for the PCED. I think looking at
right.
those like little one-offs can be misguiding because those can easily rebound the following month. But broadly, I think all three of these inflation gauges
Mhm.
are trotting higher into next year.
Yeah, I mean, it's not unambiguously clear that we're going to, I mean, the Fed's been selling this as a bumpy road, and so along the way we'd have a bump, but we're still going down the road that gets us to 2% sustainably. And you know, some of these bumps, I don't know how you mix metaphors with bumps and things that are sticky, but maybe there's chewing gum. But whatever it is, there are areas of inflation that are sticky, and certainly suggests that further easing by the Fed maybe not the thing in the world. But again, it's not like anything Travis is about the year. It's I guess from their perspective, well, if they cut by 25 on Wednesday and then they have to raise by 25 early next year, that's the nature of monetary policy making. They'll, chalk it up to the nature of the data. Okay, so let's go to figure one. So the productivity numbers came out. I don't, the productivity wasn't revised, but hourly compensation was revised onwards. And so now the number we're looking at is the year over year percent change is 2.2%. And why is unit labor costs important? Well, it's the underlying inflation in the labor market. And as you can see, this is unit labor costs again, 2.2% on a year over year basis. It's the blue series. It's volatile, but you can see the cycles in it tend to be reflected in the headline PCED, even though PCED includes things like food and energy, which you would think isn't all that impacted by unit labor costs. These things are all interrelated and they have an impact one on the other. And certainly looks like, I mean, we've certainly got a near perfect match in the latest data with quarterly Q3 unit labor costs at 2.2% and headline at 2.3 for the PCED. So the main reason that inflation's come down, in our opinion, is unit labor cost inflation came down. And the main reason unit labor cost inflation has come down is because productivity has gone up. So all consistent with a roaring 2020 scenario. We're pretty proud of this chart because we started to show it back here in the summer of 2022. We said that we thought this is what inflation would do. And then at the end of, around the middle of 2023, we added the forecast for 24 and 25. And so far, so good. So things have worked out on the inflation front for our forecast, at least. But as you can see, the core PCED is not exactly at 2%. Maybe the headline is closer to 2%, but the core isn't. And as Eric's pointed out a few times, the sticky stuff is in the services area. The rent is finally seems to be coming down, but the super core rate has remained sticky, and that's an issue. This is productivity. There were no revisions there, but you can see that it's up on a quarterly basis, 2.2 at an annual rate, and then year over year is up 2%. Eric, you want to just take us through our favorite chart here? Just a quickie, because we've done this a few times, but just focus on the kind of the latest cycle.
Yeah, productivity happens in long trends. This is the 20-quarter rolling percentage change, so it's not just blips. And we think this productivity boom or this cycle started in the end of 2015 at a very low point, just like half a percentage point of productivity growth. We had Trump 1.0. We kind of emerged from that post-great financial crisis era, and we've had stronger productivity growth since. So looking at this historical chart, our 3.25%, 3.5% productivity growth expectation looks a lot more realistic. It's happened several times in the past, and we think we're on the way there now.
Yeah, and this productivity growth cycle, we think, has more going for it, in the sense that the technologies that are out there lend themselves to augmenting, increasing productivity across a whole range of businesses. This productivity boom was basically driven by Dell and other desktop computer makers selling lots of those boxes, and then Microsoft filling them with Excel and with Word. And those are really the two big applications. Think of them as apps. And so there was a limited number of apps out there, and it was pretty costly to buy them and install them and update them. Then it was, I think, around 2011 that the cloud came in and started to kind of the revolution in software, just a real boom in software sales, more of it now being rented and automatically updated on the cloud. But maybe it could be a boom like this. This was in the 1960s, and I would say this was the IBM mainframe, jet, airports full of jets, this suburbanization of America. So it could be something on this order of the 1960s. This just shows when you do productivity, you take output divided by hours worked. And the output measure is not real GDP. It's something called real non-farm business output, but it's close enough. It's derived from real GDP, and it just shows you that that productivity is a key driver of real GDP, and that's what this chart shows as well. This is the output measure, again comparable to real GDP, and this shows you the productivity numbers. A lot going on here, but the average growth rate of output since the late 40s is 3.4%. Productivity is 2%. So labor input is the remainder. So you see, productivity is a very significant contributor to growth over time. And that Scott Bessent, who's been nominated by Trump to be Treasury Secretary, wants to get real GDP grown around 3%. Well, you can see that on a year-over-year basis, it was 2.8%. So we're pretty close, and if we're right about productivity, we should be able to do that handily over the remainder of this decade. This is another slice and dice on real GDP. This is again real output. That's this number, and this is productivity. But this time, the productivity over here, and that's the real output. So this just shows again the 20-quarter trailing percent change at an annual rate. It shows just how important productivity is in driving real output. It's a one-for-one relationship. The growth rate in real GDP is equal to the growth rate in productivity plus the growth rate in hours worked. Figure 9, just another slice and dice of the same thing. Here's that real output growth, and in this case, this is the labor input, which obviously is very cyclical, but it's very much driven by the business cycle, employment and unemployment. And you can see that of late, it's been really pretty weak, 0.6%. So at least based on these numbers, there's been a real slowdown in the growth rate of the labor force, and that's been offset by a nice pickup in productivity, as Eric pointed out. This is what's wrong with the Phillips curve. The Phillips curve ID is that when you look at the unemployment rate and put wages on here, there is an inverse relationship. There's no doubt about that. But what's missing is that there's also a inverse relationship with productivity. so that when the labor market's really tight, you get better productivity growth. And that's kind of our point of view, is that we have a tight labor market. We're seeing wages go up, but wages are going up by a little faster than prices because that's accommodated by productivity. In a competitive labor market, workers do get paid they get the real wages very much correlated with the with productivity growth. This is instead of looking at the growth rates, this just kind of at the of productivity. That's this number here, and then if you divide, if you use productivity using the CPI to do real hourly compensation, uh, you'll see that real compensation looks like there's this big pay divergence. So the workers are getting ripped off. They're not getting what they deserve. But then again, if you divide it by the price deflator, which reflects what businesses are actually getting for their products, goods, and services, you can see that the gap almost disappears. And that kind of makes sense. I mean, workers get paid by their companies for what the companies produce and what the companies can charge for their product. They don't get compensated for the cost of living. That has more to do with policy making in terms of the overall inflation rate. So here's another slice and dice of that same chart, again, using the deflator to do real hourly compensation. And you can see that hourly compensation and the productivity are moved pretty much in lockstep in terms of the broad cycle. So productivity boosts real GDP. Productivity keeps a lid on inflation because it keeps a lid on unit labor costs, and productivity allows real wages to rise at a faster pace. And then it boosts the profit margin. We've been kind of playing around with all this, and way back here in the 60s, 70s, and 80s, there was a really close fit between the profit margin using the GDP accounts and the growth rate in non-farm business productivity. And then it's become a little less dependable, and here it kind of failed. So we don't know what to make of this, but the important thing is what profit margins are doing. And as you can see, this is the same profit margin series from GDP versus the S&P 500 profit margin. And we're happy to report that they are upward trends, suggesting that maybe the productivity numbers are too low, maybe, or else suggesting that, if productivity actually continues to improve, that confirms that the profit margin here for the S&P 500 could continue to rise and will probably rise to new record highs, which is obviously great for profits. This is our forecast for profit margins. This year, 12.3%, then 13.9, 14.9. So we're expecting profit margins. Again, this is all through the magic of productivity. Eric, you want to say a couple of words on the, I guess you already said a few words on this, so maybe we don't need, this is just shows the core PCD, CPI, and PPI. And I guess what we've been pointing out is, this PPI measure of core consumer inflation. And there is a consumption price index in the PPI. It just doesn't include rent. It reflects what companies are getting when they sell to consumers. And you can see there's a little bit of a uptrend here. Not a little bit, there's a pretty noticeable one. So that's something that you want to put it on the list of sticky inflation or troublesome inflation. This is the sticky inflation. This super core. This is services, less energy, and housing. And you can see they have 3 handles on them. They're not at 2. So that's an issue. And then this is a little indicator on what the NFIB just said. And there's a little bit of an uptick here. Eric, what did you see in the NFIB? You're writing about it for tomorrow.
Yeah, I mean, November, it really just shot higher in terms of positivity or optimism. One of the things that also increased was plans to increase worker compensation. NFIB has been signaling a pretty tight labor market for some time, or a shortage of skilled labor. But I think now, that Trump's been elected, certainty is kind of back, and there's positive expectations for policy. hiring's increasing and companies want to expand. Therefore, they know they have to pay higher wages to attract that labor.
Eric, why don't we turn to the Q&A? You want to field the
Yeah.
question? You take the hard ones.
Yeah.
You take the hard ones. I'll take the easy ones.
So this first one is from Ted. It's about the longshoremen and their overall cause, which is basically, high wages and shunning automation. That could be a bad scene for 2025. Can you comment on what you see there?
Eric, you're closer to that coast than I am. The West Coast is where all the action is, but my sense is we've had some pretty substantial labor union contracts renegotiated over the past couple of years, and a lot of people thought that that would be inflationary, but there just aren't enough people in the private sector in the labor unions to really move the needle very much on overall wages. But then again, if the costs of getting stuff into the ports, and then on top of that, you get tariffs, I guess that could be a concern. We'll look at some more into it. We haven't really done our homework on that. What are you thinking, Eric?
Yeah, I mean, overarchingly, it's not great, but like it depends on how large of an impact it is. The longshoreman's already passed. We'll see if that like furls into other sectors, but for right now, it is what it is.
Yeah. Okay. William said that I'm breaking up quite a bit. Did you see the breakup?
Yeah, I wasn't sure if it was me or you, but I
Oh,
think everything was fine.
yeah. Oh, it's settled down. Okay. Yeah, we've been having some inner issues, but maybe it's those damn drones, aim of drones. Um, okay, go ahead.
Yeah, I'm gonna bump to the bottom. This is from William. I wonder if productivity failed or was lower than otherwise for a while because investment in the earlier stages of IT didn't yield real savings. Because IT wasn't powerful enough, and now IT gives that investment real potential. I don't know if you have thoughts on
Yeah,
that.
I mean that's exactly the point we've been making, kind of comparing the current digital revolution. We've been in a digital revolution since the 1950s, starting presumably with the IBM mainframe. The digital revolution is all about data processing. We've talked about this before, and AI is just sort of an evolution of the revolution. Repeat that 10 times, Eric. The idea is that it's all about data processing, and the idea is to process more and more data, big data, faster and faster and more cheaply, without without taking everybody's electricity, which I guess is an issue. But yeah, I think in the 1990s revolution was that, as I said before, there was a lot of big boxes on desks, the Dell PCs, and had to be loaded up with just a few apps. Yeah, if you had a lot of secretaries typing on Selectric typewriters, I guess you could get rid of them and let people do their own typing and using Word. If you had a lot of bookkeepers, you could get rid of them with Excel, perhaps. But that was kind of it. So it didn't really lend itself to a lot of business applications. And that's really one of, at the heart of our argument, is that the productivity growth boom, which we think we're in, and I think so far so good, but it's not an outright boom yet. Right now, it's kind of back from pathetic 0.5 to normal 2%. So we're still got our forecasting next out there for the second half of the year. But if that works out, that would be consistent. That would occur because the technology that's out there does lend itself to increasing productivity across the board.
I know anecdotally, my partner is a software engineer and they all use co-pilots to help them code. And they can do way more in languages that they typically don't use much quicker, so much so that they're worried like in the next few years, they'll be obsolete because AI models can just do it all for them. So
So that's the off-the-shelf Microsoft Copilot that's
no,
now.
there's other models that actually
Oh,
help them code.
yeah, yeah. Because I've been using a Copilot as a research assistant. It's just kind of like next level of Google. With Google, when you search, you get the links to the articles. When you use Copilot, you get a summary of those articles with links to those articles. So I think it's kind of one step ahead, and I find it useful.
There is one about TIX data and data on foreign treasury holdings, which comes out this week. Would we be concerned if there's a further drop in Japanese and Chinese holdings? And how concerned are you about treasury holdings by foreign central banks overall?
Eric, why don't you field that and also mention what you see on the equity side, foreigners?
Yeah. Yeah. So, no, I guess we're not worried is the short answer. Japanese holdings have been fairly stable. Chinese holdings have fallen in their reported accounts, but the commensurate like unreported holdings in Belgium, ostensibly Luxembourg, and potentially the UK have risen by more than a 1-to-1 amount. So treasury holdings by foreigners are increasing, if anything. What we're also seeing are increases in corporate bond holdings. So especially with an inverted yield curve here or a flat one, foreigners will buy high-rated investment grade debt and basically say it's their U.S. bond holdings. So you're seeing like $500-600 billion monthly at an annualized rate of corporate bonds, and then U.S. equities too. Foreigners are buying stocks, which like is a little worrisome because it's a contrarian indicator to some degree. They bought in 1999, they bought in 2007, but we're seeing tons of foreign demand for U.S. assets. Any worries about that or any slowdown in demand for U.S. assets you'd first see in the U.S. dollar, but the dollar has been doing great, and it might be even heading to parity with the euro. So everything looks good on that front.
Yeah, and the equity purchases have been very strong, which we kind of use as a contrary indicator, because foreigners usually get really excited about our market near the top. With all due respect to those of you who are calling from overseas, but Eric, the holidays are coming up. A week from now, Yardeni Research is going to take 2 weeks off to recharge our batteries. But I'm still going to be here on Monday. It's your call whether you got plans or not. But I'll be here next week on Monday. You going to be around, or you're on the road?
I mean, I can always, we are a
Call in.
remote
Yeah.
company. I can always hop
Okay.
on.
Okay. Good. So what we'll see. We'll be here. And Eric, what I didn't tell you is that we'll also continue to do the QTs along the way, but we could take turns. So I'll accommodate your schedule, since I'm definitely going to be working from home. I got a lot of family coming in, so and they're going to stay for a couple of weeks. So I gotta get ready to feed them and entertain them, and in between it'll be a nice break just to think about what's going on in the markets. Well, with that, Eric, thanks for joining us, folks. Thanks for joining us, and if you don't get a chance to join us before Christmas, before New Year's, before Hanukkah. All the best, and enjoy them with your family and friends. Thanks, Eric.
Thank you, everyone. Have a good one.